You're standing in line at the campus bookstore, about to drop $400 on textbooks you'll probably only open 3 times all semester, and there's this table right by the entrance. Bright tablecloth, smiling people in branded polo shirts, and a sign that says, "Get approved in minutes," with a little cartoon credit card doing a thumbs up. They're offering a free t-shirt, maybe a water bottle, and honestly, you could really use a credit card right now because your checking account is looking, let's just say, optimistic. So you fill out the form. Takes like 2 minutes. They say, "Congratulations, you're pre-approved," and suddenly you're walking away with your first credit card tucked in your wallet, feeling weirdly adult and financially empowered. My name is Nick, and I spend way too much time thinking about money, financial psychology, and why the financial industry seems to have this perfectly calculated strategy for targeting people at their most vulnerable moments. And student credit cards? They're basically the poster child for this whole system. Because here's the thing most people don't realize until it's too late. That starter credit card you got during freshman orientation, it probably has some of the worst terms, highest fees, and most punishing interest rates of any credit card product on the market. And what's wild is that the exact people who can least afford these predatory terms, students with 0 income, 0 financial literacy, and 0 experience managing debt, are the ones being offered these cards with the most aggressive marketing campaigns you can imagine. By the end of this, you're going to understand exactly why student credit cards are designed the way they are, why the terms are so brutal, and honestly, why this whole system exists in the first place. And maybe, just maybe, you'll start seeing those smiling people at the campus tables a little differently. So let's start with the most obvious thing, the interest rates. Student credit cards typically have APRs, that's annual percentage rate, basically the cost of borrowing money, somewhere between 20% and 28%, sometimes higher, which, if you know anything about credit cards in general, you might think, okay, that doesn't sound great, but isn't that normal? And yeah, credit card interest rates are generally high across the board. But here's the thing. People with established credit, good income, and a history of responsible borrowing can get cards with rates in the 15 to 18% range, sometimes lower with promotional offers. Meanwhile, students, who are the riskiest borrowers by almost every metric, are getting the highest rates. Now, the credit card companies will tell you this makes perfect sense. They're taking on more risk, so they charge more interest. It's just basic economics, right? But think about what that actually means in practice. You're 19 years old, you've never had a credit card before, and you're being charged 25% interest on a $500 limit card. If you carry a balance, which, let's be honest, most students do because that's kind of the whole point of having a credit card when you're broke, you're paying absolutely brutal interest on relatively small amounts of money. And here's where it gets even more insidious. The credit card companies know, they have decades of data proving this, that the habits you form with your first credit card tend to stick. If you get used to carrying a balance, paying the minimum, treating your credit limit like extra income, you'll probably keep doing that for years, maybe decades. You become a profitable customer, not because you're using the card responsibly, but because you're not. The people who pay their balance every month, the credit card industry has a term for them, deadbeats, because they're not making the company any money. The profitable customers are the ones paying interest month after month after month. But let's talk about fees, because honestly, the interest rate is just the beginning. Student credit cards are absolutely loaded with fees that can catch you completely off guard. Late payment fees that can be $35 or $40, over-limit fees if you exceed your credit limit, cash advance fees that are often 5% of the amount you withdraw, plus a higher interest rate that starts accruing immediately, no grace period. Foreign transaction fees if you study abroad or even just buy something online from an international retailer. And here's a personal observation. I've looked at dozens of student credit card agreements. Yeah, I know, fun Saturday night. And the fee structures are often more aggressive than comparable cards marketed to people with established credit. Why? Because students don't read the fine print. They don't know what questions to ask. They don't have the experience to recognize that a $35 late fee on a card with a $500 limit is proportionally insane. If you're late on a payment once, you could be paying 7% of your entire credit limit just in fees. The companies know this. They're counting on it, actually, because students are busy, disorganized, still figuring out basic adulting stuff like paying bills on time. Miss one payment? That's $35. Miss it by a few days, and you might also trigger a penalty APR, where your interest rate jumps even higher, sometimes to 29.99% or more. And that penalty rate can stay in effect for 6 months, a year, sometimes indefinitely, until you make 6 consecutive on-time payments. Let's talk about credit limits for a second, because this is where the psychology gets really interesting. Most student credit cards start you off with a pretty low limit, usually somewhere between $300 and $1,000. And on the surface, this seems almost responsible, right? Like they're protecting you from yourself. Can't get into too much trouble with a $500 limit. But here's what's actually happening. That low credit limit makes it incredibly easy to max out your card, which means your credit utilization ratio, the percentage of your available credit that you're using, shoots up really fast. And credit utilization is one of the biggest factors in your credit score. Basically, if you're using more than 30% of your available credit, it starts hurting your score. More than 50%, you're doing real damage. So let's say you have a $500 limit and you put $200 on the card. That's 40% utilization. Not great. Put $300 on it, now you're at 60% and your credit score is probably dropping. And remember, the whole reason you got this card was probably to build credit in the first place. But the structure of the card, low limit, high fees, high interest, makes it really difficult to use it in a way that actually helps your credit score. It's like, imagine you're trying to learn to swim and someone puts you in a pool that's 2 feet deep but has a really strong current. You're not going to drown, but you're also not really learning to swim properly. You're just struggling to stay upright. Now, here's something that doesn't get talked about enough: the marketing tactics. Because student credit cards aren't just passively available, they're aggressively marketed on campuses in ways that are borderline predatory. You know those tables I mentioned earlier? Those are often set up during the first few weeks of school, right when students are most overwhelmed, most likely to make impulsive decisions, and least likely to read the terms carefully. They offer free stuff: t-shirts, water bottles, pizza, gift cards. They make the application process incredibly easy. They emphasize the benefits: building credit, fraud protection, rewards points. They do not emphasize the 24.99% APR, the $35 late fee, or the penalty interest rate. And there's this weird power dynamic at play too. The people staffing these tables are often friendly, approachable, sometimes students themselves earning a commission. They're not sitting there twirling their mustaches like cartoon villains. They genuinely believe they're helping you. But the product they're selling is fundamentally designed to extract maximum profit from people who can least afford it. By the end of this, you're going to understand exactly why student credit cards are designed the way they are, why the terms are so brutal, and honestly, why this whole system exists in the first place. And maybe, just maybe, you'll start seeing those smiling people at the campus tables a little differently. So let's start with the income thing, because this is absolutely wild. Most students have minimal income, maybe a part-time job, maybe some help from parents, maybe just student loans. But credit card companies will approve them anyway. How? Well, there's this thing called the Card Act of 2009 that was supposed to protect young people from predatory lending. It says credit card companies can't issue cards to people under 21 unless they have verifiable income or a cosigner. Sounds good, right? Except here's the loophole: access to income counts. So if you're a student and you have any reasonable expectation of accessing money, allowance from parents, financial aid, whatever, you can list that, and the credit card companies don't really verify it that carefully. You could put down $15,000 annual income, and as long as it's not obviously fraudulent, you're probably getting approved. So you've got students with essentially no independent income getting credit cards, which means they're immediately at risk of carrying balances they can't pay off. And when you can't pay off your balance, that's when the interest starts compounding. That's when the fees start piling up. That's when a $300 textbook purchase turns into a $400 debt that takes you 2 years to pay off. Here's another thing. The rewards programs on student credit cards are usually terrible. You might get 1% cash back on purchases, maybe 2% on specific categories like gas or groceries, but honestly, you're probably paying more in interest and fees than you're earning in rewards. The math just doesn't work out unless you're paying off your balance in full every month, which, again, most students don't do. And the credit card companies know this. They have entire departments of people with PhDs in behavioral economics whose job is to figure out how to make you feel good about using the card while quietly extracting maximum profit. The rewards are the spoonful of sugar, the interest and fees are the medicine,